In the studio, he's a personal financial advisor and head at Galileo Capital. And the nice thing about Warren, and I'm not just saying it because he's sitting in front of me, is that you can pick his brain. So give us a call. We are talking about tonight about mistakes investors must never make, but maybe you've got something else you'd like to ask Warren about. So do give us a call. It's as easy as that. You can also tweet on @RayWhiteSA as well.
The Money Show. Personal finance.
Mistakes investors must never make. Now, this is a very interesting topic, as you need to be in charge of your financial destination about what you're doing with your investments. And when you go and you invest in something, very often you'll have a look at the cycle of the markets and what's happening, which I think at the moment is a little bit difficult because things are up and down due to the US Federal Reserve and things like that. You would have seen the markets today. It was a little bit of a horror story, especially with gold. But you have to be careful, don't you, Warren?
Yeah, absolutely. And I think we've been party to a few big cycles recently in South Africa. So we've had the rand that until very recently has been on this really kind of long weakening trend against the dollar, the pound, and the euro. And it's only really been since the start of this year, after the blowout post Nenegate, where it started to strengthen, and it's had a gradually strengthening time. I know with the US rates decision that weakened the rand a bit now, but that's been one very long cycle, and then the other one has been for about just over a bit more than 2.5 years now. The stock exchange has been actually going down. And so we've got two major big factors in our investors' lives. The rand is a huge thing for all of us, and then the JSE, and both of them haven't really been helping us a heck of a lot. And what happens then is we start, and it's absolutely human nature. We start to extrapolate that these trends will carry on forever. In other words, if the rand was weakening and it weakens for 6 months, we're all kind of rational, and that's okay. We can console ourselves with the fact that this is just a cycle and it'll bounce and everything will be fine. But after 2 years, we start to say, well, it's never going to get better. This is it. The rand's just going to weaken at these massive rates that it's weakening at now, and that's it. We might as well just send all our money out because, in 6 months or a year's time, it's all going to be worthless. And that's a very dangerous way to think. And I think it's probably starting to happen with the stock exchange as well, where investors are looking at their statements, after the first year of losses, saying to themselves, okay, that's okay. We've been through this before, everything will be fine. The second year, a little bit less patient, and now, and it worries me a lot. I think, they're going to start, in January again with losses again, and they're going to start saying to themselves, what else can we do with our money? Where else can we go? Because, this stock market thing just doesn't ever grow. And that's usually where that sort of mentality starts to create a critical mass. It becomes a rolling snowball down the hill, and it gets bigger and bigger and bigger, and it does cause the market to go drop faster and faster.
Surely you would look at a graph though, and you would say, right, let's go back to 2008. Things crashed then, but then things picked up after that. Let's have a look at the general trends. Yes,
that would be the logical, rational thing to do. The problem is, it's fine when we're sitting here and it's you and me, and we look at a piece of paper, or we look on the computer and we extrapolate a trend, and we fine because we're not sitting with our own money that's actually gone down over a longish period of time, and it becomes much more difficult to be rational and objective with these trends when you actually are really losing money, and so suddenly your emotional responses start to overwhelm your rational responses. And I think that's if you ask me about 2017, that's going to be the trend that worries me the most with South African investors, is that we don't remain rational. We start to become irrational.
Maybe you're listening tonight and you'd like some investment advice. Do give us a call, 021 446 0567, 011 883 0702. Maybe you want to know something about what's happening with the markets, because at the moment, it seems to be, like you say, a bit of a downward trend. Where is this going?
It's going to go up and down and sideways, Ray. So I think what's happening at the moment is we're actually seeing almost a rejigging of our stock market. For the last couple of years, the resources companies, so the companies that have been invested in the big mining parts of our economy, and certainly the global economy as well, they really have taken a lot of pain. I think in 2008, if I'm not mistaken, Anglo's was at about 500 and something rand a share as their peak. and they got to low 50s at the start of this year, and that's an extremely painful ride to experience as an investor. And you would see the same with a share like Sasol, that was taking huge pain with the oil price going down and down and down and staying down. And then what did happen was we had shares like Naspers, and before it got delisted, SA Breweries and British American Tobacco, all holding our stock market up. But it was actually only literally a handful of shares that was holding our market up. The rest were going down, and particularly companies that were very exposed to the South African economy only. So those were typically your smaller and medium-sized industrial businesses. They were just going nowhere. And now, more recently, we've seen our financial sector taking a lot of pain. When the rand weakens consistently, that's not great for the banks and the financial sector in general. So I think what's happened in the last few months and started possibly in January, but kind of quite slowly and kind of crept up on all of us, was that the resources sector started to get some life. Suddenly, Anglo's is not in its early 50s anymore.
Yeah.
Now you can price it in $200, and Sasol starts to recover with the oil price recovering. So I think the real big risks of our market collapsing might be eroding, because if you've only got 5 or 8 shares really holding you up, and those start to go down, and everything else has been going down as well, then there's a real chance for a collapse. But if the broader market is starting to find some kind of a basis and some kind of a level, then possibly the big risk of a major collapse is gone.
Yeah.
And unfortunately, a lot of our future next year, Ray, is going to be determined by people far, far away, by what's going on in China, what's going on in India, because I think those are really going to be the engines of our global markets next year.
Let's take a call from Safiso in Boksburg. Hi, Safiso. You're talking about treating your investment as a trader. Is it a good idea?
Yes. So good evening, gentlemen. So I've been listening to Warren and Bruce over the years, and Warren would say, guys, stop buying and selling, never a good idea. So over the past few years, I'll buy and just hold and try to go for the long haul. But I've noticed that during the year, over the 12-month cycle, there'll be a lot of fluctuations, daily movements, weekly movements. But over a 12-month cycle, I'll probably, best case scenario, I'll aim flat. Worst case scenario, I'll start the new year at a loss. And then this year, obviously, I'll get jittery and stuff, and I'll start noticing this thing, depending on whichever sector I'm in, whether I'm in resources or the industrials or financials. I've noticed that there's all these highs and lows or whatever, the daily movements, crazy daily movements, a lot of volatility. So I'll start targeting the lows and buying the lows, and trying to sell on the highs. And I think I've made some money for the first time than trying to hold for the long haul, to avoid those losses that I've been experiencing or those threats that I've been experiencing. So I just wanted to hear what Warren's view is on that.
Oh, very interesting. Safiso in Boksburg, thanks for your call. Yeah.
So, Safiso, I think it's one of those things where there's a possibility of making money when you do trade. The difficulty though is that it's very difficult to do it consistently over a long period of time, because actually what you're talking about is market timing. So what you need to be able to do is find your investment. Let's stick with the resources share. You were saying you looked at resources. So you would look at a resources share, and let's just say it's Anglo. So you would buy it low. So that's your first decision. Then you've got to wait for it to go up, and you've got to be pretty accurate about the fact that it is going to go up. So you wait for it to go up again. So then you take your first batch of profit, which is great. You sell your share, you make some money. But now it goes. You need to now wait for it to go down again, and you need to buy again. So you need to make 3 decisions in that kind of a cycle. And what history shows us is a lot of the time people can be reasonably good on buying low and waiting for that movement to go up and sell. That's fine. But now you've got cash, and you need to wait for it to go down again and then buy. And that's really where most of the time investors, and I'm talking about private investors, institutional investors, et cetera, don't get that right. And I think the hedge funds are probably the best example of this for us to see on a large scale. And to give you an idea, I mean, Warren Buffett took a bet with a bunch of hedge fund managers quite some time ago that he would just buy one thing. And I know it's not going to surprise people that listen to the show. He just bought the index. He bought the S&P 500 index. He did nothing else. He bought it, he put it away, and he bet anybody who was willing to take the bet $1 million that his one index, and everybody knew what it was, would outperform any hedge fund or collection of hedge funds. And for about 2 years, and I'm really talking to Safiso here, because for about 2 years, that index really didn't do well. he wasn't looking all that bright as an investor. The hedge funds that were chosen, there were 5 of them, were doing pretty well. And then all of a sudden, the index kicked into gear. It started delivering returns, paying dividends. And now that bet is so far in Buffett's favor that the hedge fund manager who took that bet has basically said, look, we're just waiting for the time to come out because it's 10 years. But there's no chance I'm going to make that money up. And Buffett's won the bet. Clearly, Buffett gives that money to charity. He doesn't need the money. So I think that trading idea, it's such an attractive thing. And you can be right every now and then, but it feels to me a lot like flipping a coin. It's a buy and a sell, so it's a heads or tails decision. And you can flip a coin and choose heads 10 times in a row, and then all of a sudden the tails arrive. And I think that's a bit like this trading decision. You're not going to be right all the time, and unfortunately, you might be more lucky than skillful at the moment. And I mean that with the greatest respect to the traders as well who do this for a living. There are not many of them that are sitting in the world's richest men for a reason. The world's richest man is an investor. He's not a trader.
But surely it goes a little bit further than, say, walking into a casino and saying, right, red or black. It's a little bit more scientific than that. Yes, of course it is. And there are people with, 17 mathematical degrees that have built fantastic, sort of learning, deep learning machines where the markets are being analyzed by, really, top mathematicians and then supercomputers that are trading. What's interesting is that they don't make money like the investor does. And I think that's the point, is ultimately when we're talking about something like this, just think of the complexity. Firstly, you've got to predict the event. In other words, you've got to say something is going to happen, and then you've got to be right about the result of that. It is going to happen or it isn't going to happen. Okay, so that's the first decision. Okay. Then you've got to invest according to that. So that's what you've got to do. But not only that, you've got to decide or predict actually what the market's going to think about that event. So it's not just good enough to say, this is what I think is going to happen. Now you have to be right about that. You also have to be right about what the market thinks about that, and then make your investment decision according to how other people are going to react to something. So if we think about something like Brexit, that's a very clear example. We didn't get it right, let's face it. Nobody got it right. Everybody got it wrong. Nobody predicted that Brexit was going to happen. And then we couldn't predict that actually the market would go up. We couldn't predict, for example, Trump was going to get elected and that the market would recover and actually shoot up when he was elected. So now making a trading investment strategy around that, to me, is highly, highly dangerous. But if you are a little bit, I don't know, daring or whatever, and, Donald Trump, I'll never forget, I was doing the midday report the day before the US election. And I had this company come on, and they kind of do polls and things like that. And the guy said to me, he said, Ray, Donald Trump is going to win. And I must admit, I freely admit it. I said, absolutely not. No, he's not. Hillary's ahead in the polls. She'll be fine. This guy's too extreme. And this guy said, he's going to win. And he was right, of course. So if you have that sort of, I won't say insider trading, but that sort of insider knowledge, you can make some money. You can, but I think the polling companies, as an example, those are not a bunch of idiots sitting around a table. Those are highly sophisticated mathematicians that have built huge algorithms using massive databases of information and trying to analyze trends. And so there's a business that only exists to predict something, and they got it horribly wrong, not once but twice in 1 year. Yeah. So you're right. As far as I know, there is only one business, and it is a South African business based in Cape Town, I believe, that managed to call both Brexit and Trump correctly. The issue there is, will they get the next prediction right? And how is it that you and I are sitting around here around our computer can have access to information that will allow us to understand the market with that kind of depth and that kind of certainty? Because remember, that's the other thing here. You've then got to place your bets. You can't just sit in the sidelines and have a conversation. Now you've got to commit real money to make a lot of money out of something like that. And usually that means you're borrowing money, so using leverage. So you have to have enormous conviction that you're going to be right. And it just doesn't work. I mean, the most famous example to me is a business called Long-Term Capital Management. Yeah. That absolutely blew up in the States. And the interesting thing about them was that they had this collection of minds that have never been seen before, since lots of Nobel Prize winners that were helping them analyze what the markets were going to do. And they ran out of money before the markets decided to do what they were predicting the markets were going to do. And so I think this trading thing is extremely difficult, and especially for us, where we've got our market
and the rand, and now the oil price, moving in huge steps, and three huge factors that really drive our stock market. And then don't forget, we've also got to rely on our politicians to just be stable.
Hey, don't say anything. What 9/12 is now past. Today's the 15th. Don't give anybody any ideas.
Exactly.
Now, looking at keeping money in fixed deposits or cash, that kind of thing. I mean, let's play it safe now. Is that a good idea?
It's just so tempting now. If you look at some of the banks that are advertising, you can put your money in fixed deposit and get 9%. And if we think about, lots of people will dispute what our inflation rate actually is. But let's just say, for argument's sake, because I know then the screens light up with people saying rubbish. But let's just say it is 6%. That's our inflation rate.
Sure.
And now a bank is telling you that they will give you 9%, a guaranteed return of 9% for the next 12 months. That's 3% above inflation. It's definitely an attractive proposition. It'd be something that people will seriously consider, especially because we've had low interest rates for quite a long period of time, and cash investors haven't been rewarded. So my comments there, the two things to think about when you make that decision is, one, just understand that most of us will pay tax when we earn the interest. So that return is not going to be 9% by the time it actually hits your back pocket. You're going to pay full income tax on that. And secondly, when the market recovers, and I'm not saying if, when the market recovers, it recovers in a huge, big jump. And unfortunately, it doesn't just do it in a nice, gradual, well-advertised manner. It shoots up. And it suddenly surprises you, 2-3 weeks later, you look back and you go, wow, the market's way up from where it was a couple of weeks ago. The rand's a great example. If we think about it, it's around about 17.50, 18 to the dollar in January. Look at it now. And we wouldn't have said so. Look at all the politics and the bad news that we've had, and the rand's stronger. So I think, I would be saying to someone that's committing money to a fixed deposit, that's fine if you've got a specific purpose for that money after the 12-month period. So if you say to yourself, I need to use that money to put a deposit down in a house, or to pay for education in a year's time, whatever the deal is,
sure,
go for it. But if you want to make a 5 or 10-year investment decision, and your best idea is put it in cash, you just need to understand inflation and tax are probably going to hurt you. So over long periods of time, cash will give you round about 1% a year above inflation. So it's not a great long-term investment.
Watch out for that for the tax. Okay, Selma in Krugersdorp. Hi, you have a question about long-term investment.
Yes, thank you very much. I had a long-term investment with one of the big companies in South Africa that was due to pay out on the 1st of November. Now, they did a calculation of the value of the investment on the 28th of October. And, on the 31st of October, the charges against Pravin Gordhan were withdrawn and those kind of things. So I thought that there was quite a big jump in the market, but they still paid me out the value as was calculated on the 28th of October. Do I have a case, has there been, would you say that there was a significant move in the markets between the 28th of October and the 1st of November, or am I just being peckish?
Salman Krugersdorp, thanks for your call. Good question, Warren.
I have to be a bit like Nas Botha now and sit on the fence and say on the one hand and on the other hand. So, Salma, I think it's going to depend on a couple of things. One, it will depend on what you invested in. So if you were investing in something that only invested in the stock market, then there might be some case to review the performance there, because if the markets did jump, and I honestly can't remember, I know the rand did very well, but I can't remember what the JSE itself did over those few days. You might find it didn't jump as much as you think. I think it was more about the rand than the JSE. But if it moved dramatically, it would have moved by 1 or 2%, which is a huge move in a few days. So it wouldn't look like a lot on your statement, and that would be only if you were investing in a pure share-based investment. If you were investing in something that was more of a guaranteed portfolio, or they might have used it jargon like a moderate portfolio or balanced portfolio, then you would have had a mix of assets. You would have had some cash and some bonds, some property and some shares, and then your overall growth would be a bit more muted than the 1 or 2% jump that the market might have given you. And then if you were actually invested in something that was really a rand hedge investment, so it was actually a South African investment but invested overseas, you might actually have lost money from the 28th to the 1st because the rand was strengthening over that time. So I think it's very difficult to answer that question with certainty. But I think 1 or 2% jump would have been the best you could have expected over that time.
Just please, no shocks for December. That's all I say. No shocks. Just leave the finance minister alone. Let us have our Christmas. Personal financial advisor at Galileo Capital, Warren Ingram. Great to have you on the Money Show once again.
Thank you very much.